Good afternoon. Thanks for tuning in. You're watching Countdown on Bloomberg Quint Live, India's first digital live streaming business news service. I'm Navneet Saluja D'Souza. Well, these are the top headlines that we're tracking for you at this hour. Markets remain in a range after a sharp correction seen yesterday. The Nifty trades above the 11,600 mark. Pharma and financials are the top sectoral gainers. The volatility index went past the 26 mark in today's session, its highest level seen since February 2016. GAIL is the top loser on the Nifty after it emerged as the highest bidder for the wind energy assets of IL&FS. And there is no respite for oil marketing companies as crude prices remain at elevated levels. Good afternoon, Neeraj. Well, some respite after yesterday's sustained selling pressure that we saw.
Let's see if this lasts, because crude refuses to budge, Navneet, and I don't know if that remains the bigger draw. But yeah, for now, Navneet is right. There's some respite after yesterday's incessant selling. Crude stays high. VIX, no matter what the level is today, you would have to argue that it is high, 2.5% higher. It could well have been 2.5% lower, but these are high levels for volatility as well. And turnover in today's session, let's see, yesterday was a particularly low volume day. FIs trickled down the volume as well, but the trading volumes were low. In today's session, it seems to be higher than what it was yesterday at the same time. The question is, can it move up further from these levels and nudge the 30,000 crores on the cash side? That remains to be seen. The F&O volume certainly higher. As we head closer to expiry and the monthly expiry, you will probably see the volumes anyways move up higher. Bring up the heat map and show you what's moving and what's not on the index. Well, even Stevens maybe some more advantage to the green, but hardly anything. Not too many losers. The gainers have a bigger upper hand, and I'll talk about them. But firstly, the losers. All marketing companies continue to grind a bit. So BPCL is down about 1.5%, and we have IOC out there too. TCS is marginally soft. GAIL, unrelated expansion, and the market has not liked it. About 1.5% lower, irrespective of what happens today. And there could be some buying that could come in, but otherwise, the move is seen as fairly regressive from a minority shareholder's perspective, and the stock rightly getting punished. What's doing well? Z Entertainment, and I would reckon this is on account of brokerages now taking cognizance of the interaction that Subhash Goel had with one of the print papers, Economic Times, I presume, if I'm not wrong, wherein they spoke about a deal, the sheets being, or the binding term sheets being very, very close, and maybe that is something that the street is taking heart from. Indiabulls Housing Finance bounces back a little, as does Yes Bank in the session today, and Bajaj Finance about a couple of percentage points higher in the session today. So that's the other interesting one. Reliance Industries bounces back, and that is giving that support. You have ICICI Bank, Reliance, Bajaj Finance amongst the names which are helping hold the index well. And IT, while TCS may be soft, but Infosys is certainly still doing okay for itself. How have broader markets done, Devina? What about the market breadth?
Well, the market breadth, at least from the start of the trading session, looked positive, and hopefully it stays like that towards the end of the trading session as well. There's a brief period of a crisscross, but as you can see at this juncture, we're still comfortably in the grip of the bulls, at least, if you can say so. But in terms of what's been happening in the mid caps and the small caps, you have seen some amount of interest building up, and I'm going to start off first with a few counters. Reliance Capital, for one, in today's session, that has been up in trade closer to about 12% after being knocked out of shape yesterday as well as the day before that. Reliance Infrastructure is up 4%. You've got a Diwan Housing Finance, again, a bounce back from the 10% sell-off that you saw in yesterday's trade on the back of that CRISIL downgrade on its commercial paper. Prestige Estates, 3.5% higher. You've got Indiabulls Ventures, Sterlite Technology. Remember, you're going to watch out closely for the numbers of Sterlite Technology. The stock has not been a favorite in the recent past, so this is a time for redemption, and you got some movement in the stock. Cholamandalam Investment, you've got Reliance Power. Amongst the losers, HEG is down 4%. Graphite India is down another 3.5%. So both moving in tandem. Indian Hotels down 1.5%. From the small cap space, if we could just quickly pull that up as well, we'll tell you the big movers thereabout. Jet Airways is a big bounce that's coming about in the counter. Yesterday's session saw a precursor of this move in today's session. You saw it towards the last dying moments of trade, stock jumping up into the green. Indiabulls Real Estate, remember, you're going to watch out for the numbers ahead of that. The stock's up about 3%. Radico Khaitan too. Watch out closely for the numbers as well. Losers then, Reliance Communication, a regular feature out there. Karnataka Bank, Gen Irrigation, South Indian Bank are some of the bigger losers within the small cap space. But what's happening in the more liquid universe? In the derivative space, Navneet is going to highlight that for us. Navneet.
Thanks for that, Devina. Well, if you look at the Nifty futures right now, we've seen positions being, of course, being rolled over to the May series, and yesterday's rollover somewhere was about 26%. So that's picked up so far. The rollovers have been in line. The Nifty is, by the way, trading above its key moving averages. The 11,600 mark was pretty crucial. So right now everything's going well for Nifty. But for Bank Nifty, that's moved below its 20 DMA, which was seen in yesterday's session. It is trading below that mark of 30,000, and but some respite actually coming in from banks like Yes Bank, which had tumbled nearly 10% in the last two sessions. So that's seen some bit of comeback, and the rollovers right now for Bank Nifty also look good. VIX remain at elevated levels, but it's cooled off from the highs that we'd seen at least in the morning session. But still, it is around the mark of 24.7, which is at a 3-year high. In terms of the active option strikes for the day, 11,700 call and the 11,600 put. Now these are very, very active strikes. If you look at the 600 put, that's added nearly 11 lakh shares. Yesterday was the day when there was immense call writing that was seen in the system, and today 11,700 is once again witnessing some bit of writing. 14 lakh shares have been traded, and if you go by the premium, you club both of them, it's coming somewhere about 55 to 60 rupees. Probably that's the band that you can watch out for on the upside or on the downside going into expiry on Thursday. Stock futures, Z, one of the top gainers in Nifty. The stock's doing pretty well, but for the series it's down 6%. Some positions being rolled over created for May series. As of now, fresh long positions seen for Z. GAIL is the other one, which has seen some weakness after the news came in that the company's emerged as the highest bidder for IL&FS wind energy assets. If you look at the futures data, clearly open interest buildup has been significant. So shorting seen for this one. And lastly, another heavyweight on my list, that's TCS. Somehow the stock's been weak in today's session. It may have recovered from the day's low, but it's still trading with cuts of 0.7%. And what caught my attention was also the build-up that one has seen on the futures side. So a lot of OI interest seen for TCS.
Let's begin with the market voice. Vaibhav Sanghavi of Avendus Capital joining us right now on the show. Vaibhav, good having you. Thanks much for joining in. The market tends to gyrate a bit here and there on a daily basis. However, the primary concern would now remain crude, and just in the morning showing about how the spread between Brent and NYMEX is widening as well. So while crude is moving the way it is, Brent is moving up at a faster clip, which is even more worrying for India. Do you reckon that this optimism around what the markets could do in the near term because of other factors might be short-lived if Brent continues to stay at these elevated levels?
No, you're right, absolutely, that elevated crude is not very good for India in terms of the economics, macroeconomics. At the same time, what we also need to understand that over the last month we have rallied very well, and the market also bakes in some amount of optimism, of an outcome, where we are at this point in time standing. So. Given that there's a change, marginal change in other factors, and on an overall GDP also, we have seen some amount of softer numbers in the last quarter. There is a possibility that we may consolidate on the markets at this point in time or for some time, and wait for the outcome of the election before taking a fresh leg up. Having said that, the global environment, on risk hasn't changed. And it continues to be positive on the global side. But elevated crude price definitely gives some amount of worry on the economics side at this point in time.
Vaibhav, just shifting back to individual pockets in the stocks which have been in news,
what we do understand is basically in terms of the valuations, and at this point in time I'm not going into the merits of an individual company or their own decision, but in terms of the deal and the kind of assets which they had, and at the same time along with what they have in terms of the power purchase agreements as well, it appears that from the face of it that it is not pretty steep, but it is fairly valued. I would say fairly to richly valued. So Yes, we do not have all the details in terms of that deal, but prima facie it looks a little bit expensive.
And so far, what have you made of the earnings season? Primarily, we've got big numbers actually coming in from the ID pack. We are done with Infi, TCS or Wipro. We'll be getting some big numbers this week as well from some banking companies. Overall, what's the prognosis when it comes to the earnings? Because, of course, last 4 years have been disappointing. And going into FY20, the expectation is that we will be witnessing a 20% EPS growth on Nifty. Do you see that happening?
No, so if you see typically over the last many years, the first half of the earnings season is always better than the second half of the earnings seasons. And why? Purely because, we in the last 4 years or 5 years, we had those kind of all PSU bank stocks or, where we, all the write-offs that we made, recognition of NPAs was being made, used to typically come out in the second half of the earnings season as well. So this time around, we do not expect that kind of turbulence happening in that pack. But we do think that till now, whatever the earnings have been there are pretty much in line with expectation. There is nothing in an extraordinary basis where either they have underperformed or outperformed. Having said that, for FY20, as compared to the street, which are estimating earnings increase in the range of anywhere between 20 to 25%, we do expect that the earnings should be close to, or even if it is 15 to 17%, we should be extremely happy. We would be extremely happy.
So everything's going well for India, Vaibhav. We're getting good FI flows in the last 1 month or 2 months, and plus the expectation of 20% growth. I don't know if any other market is going to grow at that rate, at least in this financial year. So what could be the potential headwinds, according to you, for Indian markets going ahead?
Of course, I don't know about the immediate short-term event which is there, and based on the outcome of that event in terms of the election results, the markets can swing in a very short term. But again, as I said, depending upon how it shapes up, we do at the end of it by FY20 and 21 do estimate that the earning recovery is going to be robust. Also, to add on to this is basically from the global factors where Fed has clearly mentioned that interest rates have topped out, and what they were earlier assuming of quantitative tightening programs to be prolonged is now being curtailed to September. So in all, what we are seeing is basically that liquidity scenario and at the same time interest rate scenario are positive for risk on environment globally. Of course, you will get some amount of volatility or bouts of selling in between, but in combination of all these things, where you will see some amount of flowing into the emerging markets, plus your economy, which is likely to recover post elections, and the numbers which are going to be strong, FY20 and 21 looks pretty okay from here.
Vaibhav, if any, in those bouts of volatility, if we get to witness, because of course, we're going to be getting the general election result towards the end of May, which are the pockets, in case if there is any correction, which are the pockets that you would be looking at closely?
Okay, so in terms of pockets and sectors, I would say that we continue to be bullish on 3 important sectors of our Indian economy, which is banking and finance, 2 industrials, and consumers. Although consumers in the last 6 months have not been very exciting in terms of their numbers and their purely because of some amount of slowness in the demand on the rural side, but we do estimate that post election we might see some amount of pickup there. At the same time, in consumers, discretionary is also a space where it has been pretty mixed, wherein on one hand the autos and autos related stuff have not been clocking in good numbers, but the other discretionary have been pretty strong, like paints. So it is pretty mixed out there, but on a longer term basis we are extremely bullish on all these 3 sectors. What we are at the same time, while we are bullish on these 3 sectors, something which we are avoiding is basically NBFCs with weak liability franchise. We still think that there is some amount of time till they get back, on normal business or doing normal business kind of stuff.
Right. Vaibhav, on topics that, since you just mentioned that NBFCs is a space that you'll avoid, I'll keep it to the spaces that there are some concerns that could probably be an avoid, or for that matter, a contrarian call, which we're hearing right now, and that is the telecom space. While the anticipation is that you might actually see growth coming back into the telecom space starting only 2020, the fact that most of the telecom companies, the three major ones, they're stacking up for a big kicker in terms of their ARPUs moving up from decadal lows to the fact that they're deleveraging and they're creating a war chest for 5G rollout if Jio does that earlier than expected.
No, of course. I mean, we are starting to have a very constructive view on the telecom space on an overall basis. See, at the end of it, what we need to understand is there is a huge secular opportunity for telecom related services in India, because purely because of the power of demographics and the power of spending power of people. So telecoms on a longer term basis is of course going to make huge amount of money. It's just that in the shorter term turbulence where they are marred with heightened competition is a game of survival of the best or the fittest. We do estimate that 2 or 3 key players in telecoms will continue to survive for a long period of time, and thereby would have good prospects as a business. So that's for all the reasons which you've mentioned as well, is that we are looking at that space on a constructive basis.
Okay, Vaibhav, we'll leave it at that note. Thanks a lot for joining us and taking us through your market views right now, and we appreciate you joining us today on the channel. Well, just shifting focus back to the markets, we are just about there around the levels of 11,632. Some bit of weakness seen today from the ID pack. Definitely, we were seeing TCS, which had seen some bit of knockout, but some pockets, at least from the mid-cap space, pull up something like Newland Laboratories. That had seen good traction, good buying interest. I think it's gone up on good amount of volumes as well. Let's see if the buying continues in that one or not. Newland Laboratories is the stock I'm talking about, but we'll pull up that stock for you. But besides that, I think we've got Tejas Networks management with us.
I think a very strong quarter for them, Navneet. Yeah. And the management is joining in to talk about all of that and more. The revenues have more than doubled on a year-on-year basis in this quarter. They've managed to post a strong profit growth, and above all, I think they've achieved their guidance after 6 straight quarters of missing it. So joining us right now to talk about this quarter and how things have actually shaped up is the MD and CEO, Mr. Sanjay Nayak. Mr. Nayak, thanks very much for taking out the time. Let's put things into perspective as to how the quarter gone by has been. It's not been bad at all. More than doubling in terms of revenues. Profits have come in higher as well. What contributed? I see your margin performance has also been relatively stronger.
Yeah, so thank you, first of all. Let me also clarify one thing, that as a business, we are inherently lumpy in nature on a quarter-by-quarter profile. So as a result, we really look at as an annualized basis all our numbers. So yes, you will see that Q4 was relatively better. But the way we see our business, that the annual rate was around 18.5% year-on-year growth in terms of revenues. And on profit before tax, we grew around 42%. So I think that's the way we look at it. Secondly, what's been driving the growth? Really, there are 2 elements. Directionally, we have 2 parts of a business that we focus on. One is the government business in India, which is through the operators as well as BharatNet and other kind of projects. And the second is what I call is the run rate business, which is private operators in India as well as the international business. So the second part of our business, which is the run rate business, which is less lumpy, actually has done extremely well this year. We grew 33% year on year on the India private and international combined. And within international, there are 2 elements for our business. One is the direct business, where we sell under our own brand name. That has actually gone up 70% year on year. And the total international went up by 39%, which basically meant that the OEM business, which we used to do earlier, which used to be about 1/3 of our revenues few years back, has actually come down to marginal levels, and now we are selling it on our own brand. So net, I think strong international, strong India private, and a decent government business kind of gave us a decent year-on-year growth.
While you say that business is lumpy, is there any sort of a visibility on the international side? Because I believe you're looking to ramp that portion in terms of revenue contributions as well, compared to the kind of contributions that come in from the Indian government and the other aspects.
Absolutely. So in fact, the nature of our business is that the sales cycles are quite long. So actually the impact we are seeing on our international business this year is the effect of all the investments we've made over the last 18 to 24 months. So the good news is that in our business, once you get into these large operators, for example, in any country, initially you start off with smaller orders. But once you establish your name and once they start using your equipment and they get comfortable with it, the same customers start giving much larger business. So in fact, as a result of this, the number of customers that we added around 27 new international customers, and 6 of them have now graduated as what we call tier 1 operators, which are pretty much the number 1 and number 2 operator in any country. So I think that's been the good part for the international business, where we've built up the platform, I would say, over the last 18 months. The impact of revenue growth started to show this year, and we are very confident that based on the platform that we have and the visibility we have, because now we are more in the run rate accounts in these customers, we should see a good growth in the next year as well for the international piece.
All right. What is the target that you aim to bring the international business up to in terms of revenue contribution?
So over a medium term, which is about 3 years, we think international will be about 50% of our business and India will be 50%. Within India, we of course have been growing the India private, which is the non-government business, quite healthily. It actually grew 28% year on year. And within the government business also, we actually have 2 kinds of business. One is the large projects like BharatNet, etc. The other one actually is also now steadily growing up quite well, which is the critical infrastructure business, which is the telecom networks of railways, power, oil and gas, smart cities and stuff, defense, stuff like that. So the second part of the critical infrastructure business is more like a run rate business where we get orders every few weeks or months. So I would say we would pretty much make sure that the India private and the critical infrastructure becomes a solid run rate business, and the dependency on the lumpy part of the business, which is these big projects, reduces over a period of time.
The order book, what does that look like currently? Is there a big material change from FY18?
Actually speaking, our order book, as I mentioned earlier also, is actually a function of the government business, which we have not yet executed. So as we started the financial year, we have a 418 crores of order book, which I think around 45% of that will get executed in the current financial year. On top of that, we have about 300 crores worth of tenders of government, which where our system integration partners are L1. So they should convert to orders this year, which is something that we look forward to. The private business and the international business doesn't really have much order book, because most of the lead times in those orders are less than 10 to 12 weeks. So they actually get executed typically within the same quarter.
So you're saying a total of about 718 is what you can anticipate from the domestic side?
No, 418 is what is the POs in hand, and 300 additional is potentially orders which can get covered. Yeah, we don't count that as an order book till we get the POs, especially for government business,
All right, got that. You've met your guidance in terms of revenue growth after 6 quarters of missing it. Do you wish to put out a guidance for us?
So first of all, so out of 6 quarters, if I were to put 4 quarters as 1 year, so we've kind of always said that we'll meet the annual numbers, which I think we did. But coming back to, you actually put a very good point that the kind of business that we are in, which is still a little bit lumpy, plus as we are expanding our international, as we are changing the customer mix from a government-dominated customer to a non-government dominated customers, both in India and outside, we feel that there's a little bit, and plus even in the government business, while we have a lot of potential orders in hand, the timing of it, one will have to predict at one's own peril. We really feel that giving a guidance alone is not going to be right, so we're not going to give any guidance now. At the same time, we will give quite a decent commentary about the growth prospects. So just to give you a sense of how we stand with respect to that, we have about $18 billion per year addressable market for our products. 1 billion is in India and 17 billion is outside of India. So our real focus is to make sure that we put in the right investments, and I think think we are making the progress in the right direction. So there's definitely a lot of opportunity to grow over the next few years. The fundamental drivers like data growth, 5G, IoTs, those are all going to be good for our business. But in terms of pinning down to a specific number, we believe that we will serve better interest of everybody by not particularly putting out a number, but really focusing on the fundamentals which will drive the business farther away.
Sanjay, before we let you go and thank you, I think the full year margins have gone up by around 200 basis points. It's somewhere about 21.5% to 22%. Is there a scope for improvement in FY20?
I would say our first objective is to maintain that margin, because we are in a competitive industry competing with folks from China on one side and the US on the other side. So I think we'll be happy if we can maintain the margin. Having said that, the margin blend typically internationally is better than that in India. So over a period of time, as our international revenues keep going up, we expect that at least we should be able to hold margins or even improve slightly as time goes by. But I think we're doing pretty good in terms of margin compared to our global peers. And maintaining at the current level, we would actually be happy.
Okay. We leave it at that. Thanks so much for taking the time out and being with us today, Sanjay, and all the best for the quarters ahead. That's Tejas Networks. And hoping that the receivable picture will improve. They've mentioned in one of the notes, or maybe in the analyst call, that none of the receivables will turn out to be bad debts, at least the government ones won't. However, must say that after an initial hurrah, the stock has cooled off quite comprehensively. Good EBITDA numbers, good margin expansion.
No,
but the market not quite liking it.
Base quarter, I guess, the base was low, because I was just looking at the base quarter numbers, the revenues and the EBITDA was down 60 to 80%. As he said, he has lumpy quarters. Maybe that's why the numbers were looking too propped up.
Yeah, but as a result of that, the stock has been punished quite heavily as well. And,
sure.
And therefore
it's down 40 to 50%, I guess, last 1 year.
Yeah, and which is why this 19% EBITDA margin seemed optically very, very strong. But let's see, maybe they need to deliver it for the next couple of quarters for the street to get the confidence that this will become a norm and then take it forward. Anyways, that's Tejas Networks for you. Let's see what it does in the quarters to come. Moving on, Lupin is trading with steady gains after Morgan Stanley upgraded the stock to overweight from equal weight. It has also revised its target price upwards. Darshan Mehta is here with more on the report. Darshan, principal reason why Lupin was at least active in the morning?
Yeah, so that's about it, and that was the key reason. And I think pharma today as a space is doing well, because Sun Pharma also trading at the highest point of the day. Now, basically, it's an anti-consensus call. No major reason as such, but they believe that valuations now is attractive, and that is why, apart from the upgrade, they've raised the target price to 1094. Now they're saying that after Lupin has actually underperformed the benchmark indices, while the indices were up in trade, Lupin has fallen. And remember, Lupin has corrected all the way from 2000 and went down to all levels of almost 700. What they're saying, it appears well positioned for a recovery after the sharp fall that we've seen. What they're betting on is the niche products that could drive the revival for the company over the next 2 financial years. And earnings concentration risk has normalized, and by what was initially when it was at 2000, they were quite dependent on Glumetza and Fortamet to do drugs, and when they got generic, the earnings took a big hit and they started. So now they're saying that earnings will be more normalized for Lupin going ahead, and the new products are the catalyst for earnings going ahead. So company products like Levothyroxine, Prober, Solosec, all these drugs probably will be the key drivers for the company going ahead, but mainly valuation is something that they like at this point of time. They believe at the current value it is attractive.
All right, Darshan, thanks a lot for bringing that MS upgrade on Lupin, where they're clearly betting on the earnings now from the company. It's once again, if you look at the performance in the last 2 years, precisely that's what they mentioned in the report, and they think now the company can do better, looking at EPS of almost 37 in FY20. Okay, from Lupin, which is up 4% in trade, let's shift focus to Jet Airways. Debt troubles and the subsequent grounding of aircraft have hurt the overall growth of the industry in the month of March, but competitors have made the most of this situation to occupy the space vacated by Jet Airlines. Somit Sarkar is standing by with what the DGCA data has thrown up. Somit, over to you.
So if you see the domestic passenger growth rate in India for the quarter ended March was the lowest in the last 5 years due to aircraft groundings. Now the passenger growth from an average of around 19% in the last 3 years has now dropped to only 5% in the March ended quarter because Jet Airways and SpiceJet had to ground as many as 50 planes in this quarter, and that's the reason it has come down to such a low rate. Now if you see for the month of March only, the passenger growth rate was flat compared to last year, while for among the major airlines, if you see Indigo's passenger growth rate was the highest at 19%, followed by Go Air, which saw a passenger growth rate of around 10.5%. SpiceJet's passenger growth rate was 7.3%, while that of smaller players like Vistara and Air Asia, the passenger growth was 11% and 31%. For Air India, lastly, the passenger growth rate was negative 2% in the month of March 2019. Now, if you see for Jet Group, now their passenger growth rate declined to 65.2%, and the market share in the domestic market came down to 5.8% due to aircraft grounding. Currently, the operator has shut its all domestic and international operations. Now, because of this weak passenger growth rate, the passenger load factor, that is a capacity utilization, also declined for all the major airlines. Now, Indigo's passenger load factor declined by nearly 300 basis points, and this is for the 8th consecutive quarter where the company has seen a decline in its PLF, while that of SpiceJet, which has been able to maintain a 90% plus passenger load factor for the 47th consecutive month, has seen a decline for the 10th consecutive month compared to last year. For other players like Go Air and Air Asia, their passenger load factor increased by nearly 340 basis points and 550 basis points compared to last year. Now, on the market share front, if you see India's largest airline, that is Indigo, has just got bigger. Now, their market share in the month of March 2019 was nearly 46.9%, while that of Go Air, now that also increased to around 9.9% in the month of March. Now, in the others part, which hold around 10.7%, there's Air Asia and Vistara, which also saw an increase in the market share to close to 10.1%, while that of SpiceJet has remained largely stable at 13.6% in the month of March.
Right, Samit, thanks very much for that. And as you can see, the Jet Group pie just keeps on reducing. The other one that we're going to be looking at, obviously, is what's happening to some of these gold loan companies. And it's turning out to be the more safer haven bet for some of these names, and particularly Muthoot and Manappuram Finance. In fact, should pull up both of those stocks. And we've been hearing the management commentary regarding how the growth has been pretty stable for most of these companies. The management of Muthoot has come on our platform quite a number of times and spoken about steady growth coming in. And the stock has not been punished as much as the rest of the NBFC pocket has. Muthoot at 589 in today's session is not doing a whole lot much, but definitely, a safer haven bet within the NBFC pocket. Let's find out why. Shefali is joining in to tell us the same. Shefali.
Well, over the last couple of weeks or months, couple of analysts have actually pointed out that, these stocks are perhaps a safer haven amongst the NBFCs, which have been witnessing very volatile times and disturbing times as well, especially post the IL&FS crisis broke out. But since then, since September last year, Muthoot and Manappuram have given very strong returns. If you look at the returns, Muthoot has given about 50% return, Manappuram about 26%, whereas all the other NBFCs, even the likes of Bajaj Finance, return is not strong. It's just in single digits, whereas rest DHFL, Indiabulls Housing, etc. are down over 30%. In fact, Indiabulls, DHFL is down actually 75% since September. So what is actually working for these gold loan companies? It's basically a favorable asset liability position, which became a big concerning point for these NBFCs. And apart from that fact, it's also important to remember that these companies, when they give loans, they take gold as a collateral, which in itself is highly liquid in nature. So that puts them in a very safe position, and hence these stocks are being considered as the safer bets amongst NBFCs. Also, another factor that's been working for them is a low leverage position of these companies. So a couple of positive factors, but is it like completely safe to think that these are the safer havens amongst NBFCs? There are a couple of riskier points as well for these companies. These companies are not free from RBI's regulation, of course. If you remember, in 2012, RBI capped the LTV, that is a loan to value for these companies, at about 60%. Then later on raised it to about 75%. So they've also been, under RBI scrutiny, and that remains a risk factor. Even if you just look at the margins, they command about 20% margins from their borrowers. And if you remember what happened to the microfinance industry, RBI capped their margins and suddenly the entire industry crashed. They've picked up since then, but something similar can happen to these companies as well. They always would remain under RBI's scrutiny. But nonetheless, like I spoke to a couple of these analysts, and even yesterday Muthoot FinCorp management, they said that right now they're not really worried about any potentially adverse regulations to affect these companies. And they've also adopted a couple of risk management strategies in the last 3 to 4 years. Some of them being that they've started taking repayments via EMIs versus payments together at the end of a particular period, and they've also reduced the loan duration. So all these factors have boosted the investor confidence, and hence the strong returns that we are seeing. The only concern for them at this point in time is the nominal growth rates. The gold loan business is just growing at about 10 to 12% for most of these companies, Muthoot Finance, FinCorp and Manappuram. So that is the reason why these companies have diversified into different businesses over the last 3 to 4 years, just to strengthen their portfolio. So overall, couple of things working for them, and market is certainly giving a thumbs up to these companies.
Thanks for that, Shefali, and of course you can read this story on our website, bloombergquint.com as well. One reason why, or some reasons why the stocks are trading or outperforming the broader financial space. But full tilt towards the markets now, last 1 hour of trade, and the bank nifty is cooled off completely. So good time amidst this intraday volatility to get in our technical experts and our fundamental expert, of course, on the show, Amar Singh of Angel Broking, as well as Sacchitanand Uttekar of Tradebulls, to talk about the charts and the trades, and then Avinash Gorakshakar to throw some light on the fundamental end of some key stocks which are moving around in the session today. Gentlemen, all of you, good afternoon. Thanks for joining in. Amar, I'll start off with you. Your approach to the Nifty or the Nifty Bank today. At this point of time, what's the trade that you would initiate?
Yeah, I would say that Nifty seems to have found support around 11,580 levels, and we had spoken yesterday also that 11,500, 550, that's a very crucial support zone. So it seems that there is some possibility of a pullback towards 11,700 levels, because 700, 750, that's a crucial zone of resistance. But technically, I would say that what's happened is that if you look at the charts, Nifty on the daily charts has moved into oversold territory, and from a strong support base, that's the reason we are seeing some upside. But higher levels will be sold into, because on the daily charts we are seeing bearish divergence, and on the upside 11,740, 750, that should act as an immediate level of resistance, whereas on the downside 11,550 to start with is a good support. So Nifty seems to be range bound. Higher levels will definitely be sold into. Talking about Bank Nifty, if you look at it, Bank Nifty also has a similar pattern, with witnessing some selling pressure right now. It's moved into oversold territory. It has got very strong support coming at around 29,350, 400 levels. So from where it could bounce back, the short-term trend definitely has reversed for both Nifty and Bank Nifty. That's the reason we are seeing this sort of choppy trading sessions. On the upside, 30,200, 250 is a zone of resistance.
Okay. What about you, Sacchitanand? How are you approaching trade?
Good afternoon, Raj. In fact, we would again take a contra bet here. Last week when we discussed the markets around 11,850, when the markets were cruising up, we recommended going short in the market. We expect that this particular mean reversion property of the market should continue for another week or so, and that's why we believe that 11,550 remains as a very critical support zone for the market. On the higher side, 11,800 is the supply zone. So right now, again, we are very close to that, and on futures, I think 11,640 is where the futures is quoting. So I think this is a very good zone wherein some long positions contrary to the trend can be initiated. The stop loss for the trade should be placed around 11,590 on a closing basis, and an immediate target of a swing towards 11,730, which is the mean of this particular band, could be witnessed in a day or so. So we expect that the market should continue its oscillation within this range. But right now, since we are placed at the lower end, it is viable to go ahead and create some long positions. The stop loss for the trade should be around 11,590.
We get to the individual stocks, just want to address the markets. We've given up majority of the gains. Nifty is now just about flat, 11,600. By the way, Bank Nifty slipped into red. It's down 70 points now, trading around the levels of 29,600. So clearly pressure coming in from Bank Nifty. That's the intraday chart of Bank Nifty. As you can see, the selling pressure has just come in last few minutes of trade. Let me first get individual stock ideas from our experts, and probably we can revisit the view on Bank Nifty. Sacchitanand, individual stocks for the day?
Well, We have a combination of long and a short. The data of Reliance looks very promising. The way the stock has created a support somewhere close to 1360, 1365 zone. We believe that the stock could again swing back to 1400 levels. So this could be one of the strongest candidates and a contributor towards Nifty. So we believe that a stop loss for the trade should be placed around 1353, and long positions can be added for a target of around 1400. On the short side, the formation of the entire structure of ACC looks weak. In fact, we have been observing that the stock has been oscillating within an upward rising wedge formation, which looks now mature. We're expecting that there could be a breakdown, and the breakdown could push the stock price lower towards 1640. The stop loss for the trade should be deployed at around 1695 on futures, and short positions can be considered in ACC.
Also comes out with its numbers, so keep an eye on that one. Amar, your stock strategies?
I would say the first one is Infosys. If you look at Infosys in particular, what we are seeing is that Infosys has formed a base somewhere around 720 levels or so, and technically also it's a very crucial support zone, because if you look at the earlier decline also, that was in the second week of March. From those levels, it had rallied almost to 770. Again, it's corrected to those levels, and it's showing some signs of revival. And technically, it's moved into oversold territory on the daily charts. On the long-term charts, that's the monthly and the long-term, longer time frames, the stock continues to remain positive. On the weekly also, the stock is around a crucial support zone, so there is a possibility that the stock could witness higher, and the rupee depreciation is also helping the stock. So Infosys is a buy around 720, 722 levels with a stop loss of 704 and a target of 753 on the upside. And the second stock to look at is from the banking space, and that is ICICI Bank. If you look at ICICI Bank, what we are seeing is that ICICI Bank did correct over the last couple of days. But technically it continues to remain extremely strong on the intermediate as well as the long-term trends. And on the daily charts, yes, we are witnessing some signs of some consolidation, but still any pullback should be used as a buying opportunity in ICICI Bank. So ICICI Bank is a buy around 394 levels, 396 level zone, and with a stop loss of 387 and a target of 413 on the upside.
Okay, those are some stock ideas. Avinash Gorakshakar is also here with us. Avinash, good afternoon to you. Yesterday was a slightly painful day for the markets. We saw some pullback, particularly the drag came in from the oil and gas pocket. Crude's not moving anywhere in a hurry right now, at least on the downside. It may go up. But do you believe that the pain could be here to stay for some of the oil marketing companies and even the upstream companies for that matter?
My guess is I think this quarter may not be all that bad, considering that there could be some inventory gains, but in the coming quarter, that is first quarter of the next financial year, could definitely be a lot bad for these companies, considering that GRMs could be under pressure. And I think crude is definitely on a boiling point, and hopefully if it consolidates or comes down, then only we could possibly see some kind of relief for these oil marketing companies. I think the upstream companies, Devina, could do a lot better. I think probably an ONGC or maybe a Reliance or an Oil India could be better bets. Oil marketing companies, definitely considering the kind of rise in crude prices, could possibly see their margins under pressure. And with 23rd May election day, I don't think even the elections, the government would give them any sort of relief. So my sense is I think it's better to keep away from the oil marketing companies for the time being. I think wait for at least a couple of quarters and obviously see how crude behaves in the near term.
So if you had money, what would you invest in right now?
I think clearly, two areas which look safe. I think the IT pack and the FMCG pack. Hopefully, we have a good monsoon. You could possibly bet on some good frontline, FMCG names like a Lever or maybe a Godrej Consumer. On the IT side, we still continue to be positive on frontline companies like HCL Tech, typically, niche players like L&T Technology Services. So I believe that, here probably the rupee headwind and clearly the kind of positive commentary coming from US markets could possibly help the IT companies. Overall, I think in the next couple of months, I think it's going to be pretty volatile on the rupee front. If the rupee depreciates, I think these IT companies could possibly benefit.
What about pharma?
I think pharma has been a beaten down sector, Navneet, for a long time. I think we have seen today Lupin and some of the other
Sun
frontliners.
is at days high right now.
Yeah, so I think clearly, I would be a little apprehensive as unless we see some earnings, improvement and better management commentaries. I would believe that maybe most of the downside has already happened. But until we see some operating, metrics improving, I would believe that, these are some kind of technical bounce, which probably, unless we see some better numbers in the fourth quarter and maybe in the coming financial year, specifically companies, which export to the US, I think definitely could do well, hopefully, if there are no more regulatory kind of hindrances.
Do you track Newland Laboratories? That's the other pharma company which is shot up in today's session, about 9 to 10%.
We don't have an earnings
Okay.
But interesting volume action as well out there on Newland, 718. Actually, before we move on to the other stocks, Newland Labs on the charts, Sacchitanand, Uttekar, good price, good volume action.
We are talking about
Newland Labs. Newland Labs.
Sorry, I don't have the
Never mind.
price updated here.
It's completely fine. But it's looking interesting on the charts today, 9.5% higher. The other interesting mover, Avinash, is Z Entertainment. Now, arguably because of the interaction in the Economic Times, wherein Subhash Chandra Goel has said that the term sheet would come in by the first week of May latest, is probably one reason why the stock is excited today. Macquarie's come out with a note as well.
Yeah.
But all of that notwithstanding, if indeed we work with an assumption that they hold on to the timelines, is this a stock that is giving you a chance to enter because the deal is imminent? Or would you believe that because the contours of the deal are not known, it's best to stay out right now?
Oh, whether most of the run-up has already happened.
That's the other thing.
From the lows of around 340, I think.
No, I think, Neeraj, it's better that, once we know what are the contours of the deal, because clearly yesterday one of their group companies decided to sell out to Blackstone. Although the management has made it very clear that there is no linkage to this from a promoter funding issue, I would believe that, what kind of, strategic stake happens, at what price it happens, clearly is going to be a very important point. Obviously, there are 5 or 6 bidders, but looking at the way the entire pledging issue has happened, the markets and probably most of the analysts would be penciling a kind of a rapid growth trajectory only once, this issue is finally cleared. And I think entirely, because clearly these kind of assurances have been given by Mr. Subhash Chandra earlier also. So I think let's wait for the final deadline and then see how the stock behaves.
So 30th September, you wait it out.
At least it could take a couple of months, Devina. I don't think it's going to happen in a hurry. At least
no, because that's the deadline that they have given to the agreement with most of the mutual fund.
Hopefully it should happen once the elections are over. I think clearly, maybe in the month of June or maybe July, but typically I think what kind of price is the incoming investor willing to pay? Is he willing to pay a premium, or whether he pays at a marginal, kind of price above the market price? I think these things would be very important, because clearly, the equity stake in totality, I think any big partner who comes in would obviously like to have a controlling share, and that is probably going to be a pain point for the promoters.
On the charts though, Amar Singh, come to you with a Z and an SL Propack also. I mean, obviously SL Propack in the midst of news there, but over the last few days, any movement that you've spotted that could trigger some upside for the counter?
Yeah, talking about Z in particular, what we're seeing in Z is that the long-term trend still remains quite bearish for Z. On the short term, the stock has bounced back, and on the daily charts, if I look at it somewhere on the upside, initially 415, 420, that's a zone of resistance. If that is taken out, then the stock could rally towards 440, 450 levels, because on the daily charts, we are seeing some sort of consolidation and a possibility of a pullback. But for that, as I said, 415, 420 is a crucial zone of resistance, so that needs to be taken out. And looking at the other stock which you talked about, if I look at SL Propack, SL Propack continues to trade extremely firm on the short term as well as the intermediate term trend. It continues to remain extremely strong. Even on the long term trend, the stock remains positive. So I would say that the stock sustaining above 128 levels, 130 levels clearly shows that there is more upside to it, because on the long-term charts also the stock has a potential to rally towards its second quarter high of in 2018, it had made a high of 145 levels. So there is a possibility that the stock could rally towards those levels.
Okay, let's stay on German. Let's talk about the chart of the day today. SpiceJet has been making headlines, drawing up plans to take over Jet Airways market share, but Interglobe Aviation has actually gone and secured the regulators not to fly on a lot of these routes. Samit Sarkar is here with those details. Samit.
So if you see, India's largest aviation company seems to have made the most out of the issues faced by its rivals in the month of March. Now, the total capacity addition, both on the domestic and on the international routes by Indigo in the month of March has been nearly 3 times that of the industry capacity addition. Now, if you see, and this is also for the first time where Indigo's capacity addition has exceeded that of the industry in the month of March. Now, the industry capacity addition in the month of March was impacted because Jet Airways and SpiceJet had grounded as many as 50 planes in that month, which led to a lower capacity addition for the industry. However, Indigo, which stood unaffected, witnessed a growth of nearly 35% in its available seat kilometer, that is capacity, compared to last year, thereby seeing a strong growth in the month of March.
Okay, thanks a lot for that, Samit. So that's, of course, the chart of the day in today's session. Just before we get into the next conversation, wondering, Avinash, if one were to look at what to do, how to choose between an Interglobe Aviation and a SpiceJet currently, which gives a bigger reward or bigger bang for the buck in the current scenario, how would you go about that process?
I think a more stable player could be Indigo. I think my sense is that despite the rise in crude prices, Indigo has been one of the most cost-conscious player, Neeraj, and clearly in terms of market share expansion also, looking at the way Jet has now found a lot of problems on its self, I would believe that Indigo definitely seems a better choice. I think Spice definitely would also do well, but clearly in terms of the fleet size and in terms of the geographical coverage, I would believe Indigo still deserves possibly a good re-rating kind of multiple once the crude prices cool off, and we could see possibly EBITDA margin improvements coming in.
Okay.
Avinash, a view on a couple of these banking stocks which are dragging the index lower, specifically Nifty Bank. HDFC numbers were good, nothing to complain about, but IndusInd Bank is the other one. It's been falling for the last 3 sessions now, and usually this was a bank which used to come out with its numbers first. So far, they've not announced the numbers. Do you see any fear of exposure to IL&FS, which so far has not been reported by the bank?
I think in the previous quarter they did report their IL&FS exposure, and they did make a provision, and they have clearly mentioned that in the coming 2 to 3 quarters they would be obviously providing for that IL&FS exposure. But you have been right. I think it is one of those banks which used to come out with their numbers, in the initial set of private sector bank numbers. So I think probably the markets are looking at the fact that the merger, post-merger, how the numbers would look out. Clearly, Bharat Financial numbers once they get merged, and I think the markets would be looking at it very closely. Overall, I think the auto basket is something which possibly could show some stress in the near term. But otherwise, in terms of asset quality, Navneet, they have been showing pretty strong numbers. The loan book growth, the disbursement growth has been pretty strong. So I think clearly one will have to see the numbers and see what kind of management commentary comes out. But these, this definitely is a very surprising thing that the stock is coming under pressure.
Yep, it's down, I think, about 7 to 8% now just in the last 3 sessions. Okay, Avinash, we'll leave it at that note. Thanks a lot for joining us and taking us through your views on individual stocks and also on the markets. Let's move on and talk about L&T. The company needed orders worth 45,000 crore rupees in the March quarter to meet its yearly growth guidance of nearly 10 to 12%. Well, it may have achieved that, but by when will these numbers start reflecting on the top line? To discuss the outlook for industrial and the consumer durable sectors in more detail, we're joined by Aditya Bhartiya of Investec Capital and Darshan Mehta from our research team to take this conversation forward. Darshan, over to you.
Yeah, thanks so much for that, Navneet. Hi, Aditya. Just firstly, before we get into individual companies, can you give us a sense, because you've come out with your 4th quarter preview note on the industrial sector, what exactly are you expecting broadly before we get into each and every company?
As a part of this sector, we cover a couple of conventional industrials names like L&T, BHEL, Thermax. We have a few consumer durable names like Voltas, Blue Star, Whirlpool, IFB, a couple of outsourcing companies like Dixon and Amber, and a few electrical names, Havells, V-Guard, Crompton Consumer, Finolex Cables. So to that extent, it's a fairly diversified coverage. Within that, we expect that L&T should be reporting a decent quarter. As far as order inflows are concerned, it's now more or less become certain that the company should be able to beat its upper end of the guidance. But even on the revenue side, we think that domestic execution momentum should be sustaining. On the other hand, as far as BHEL is concerned, we think order inflows are likely to be very weak, and we are not anticipating any meaningful operating leverage benefits either. In terms of consumer durables, I think it will be a kind of a mixed bag, wherein room AC companies are likely to be performing better than other consumer durable companies. So we expect a weak quarter from companies like Whirlpool and IFB because demand has been soft in the last couple of months. So we are anticipating a single-digit revenue growth for Whirlpool. On the other hand, when we look at room AC stocks, a very interesting trend has played out, wherein excess inventory that was there in the channel for last 3 quarters has got normalized. And to that extent, we expect primary sales, that's sales from companies to dealers, to be fairly robust, and both Voltas and Blue Star to be recording almost 15% revenue growth. In terms of electricals, I think it should be a fairly stable quarter. The trends that we've been seeing in the last few quarters should be sustaining. While fan sales have been slightly weak on account of delayed summer, I don't think that will get reflected into numbers of companies because there has been a fair bit of inventory stuffing from what we understand.
Okay, let's talk about L&T in particular. You have indicated that the order inflow guidance probably will be met, and that's apparent from the order inflow that and the orders that they've disclosed. What about revenues and what about margins? Because will that be met? Margins also, they have a lot of international orders that come in, which are typically low margins. So on that front, what's your expectation?
So I think revenue guidance should also get beaten this time around. We are anticipating mid-teens kind of revenue growth for the year as a whole. And to that extent, even on the revenue side, we have seen a fair bit of acceleration, especially on the domestic front. As far as margins are concerned, first thing that we have to notice is that orders that are coming in today will not get reflected into margins. That will happen only 1.5 to 2 years down the line. And even over there, I think that competitive intensity, even in overseas market, has moderated a bit. L&T's reliance on Middle East region has come down, wherein the company has now started getting more orders from Southeast Asia, Africa, etc. as well. And to that extent, we are not anticipating any pressure on margins going forward either. Rather, what may happen is that operating leverage benefits may play out. Because the company's scale is becoming bigger and because every segment other than power sector is now getting orders, and to that extent capacities would be better utilized, and we expect with those operating leverage benefits there's a possibility of margins continuing to improve over the next few years as well.
What about BHEL? Something seems to be plaguing that company somehow, despite even a lower base, that somehow doesn't come out with good set of numbers. Is the pain expected to continue there also?
I think in terms of order inflows, we should start seeing an improvement from next year. As a country, we definitely need many more power segment orders than what are getting placed, especially in the last 2 or 3 years. And to that extent, there should be a reset in the pace of order awards. Having said that, in terms of revenues and margins and balance sheet, these are the fronts wherein the company continues to disappoint. While in terms of executable order backlog, there has been a sharp improvement in last 3 quarters, we haven't really seen that getting translated into revenues. And to us, the biggest risk in the company lies in its balance sheet, wherein debtor days are still elevated, wherein inventory days are still very high. There's a risk of continued provisions in respect of liquidated damages. And I think those risks may very well continue playing out for the next couple of years as well.
What about room ACs? In the first answer, you did indicate that you are positive on it. The only problem is that because of an elongated winter this time around and a hike as far as duties were concerned, the inventory buildup was very high on the primary segment, that is from the company to the dealer. Are you confident that this will be cleared out and they will be able to report good numbers?
Sure. You're very right. This was a fairly widespread concern. I mean, even now opinions are divided on the street. A lot of people think that this quarter could be a fairly weak one. But we anticipate the quarter to be strong in terms of primary sales. That is sales that are happening from companies to dealers. It may not be the same case as far as secondary sales are concerned. Now, in terms of inventory in the channel, one has to differentiate excess inventory that companies were carrying with excess inventory that dealers and distributors were carrying. And our sense is that by the end of third quarter, inventory at dealer and distributor level had more or less normalized. Because last year we had reasonably good Diwali sales, which is what we call as second summer, but primary sales had not matched to that. For the simple reason that dealers and distributors were having excess inventory and they liquidated that inventory. Consequently, when we entered this quarter, inventory in the retail channel was normal, while some of the companies were carrying excess inventory, and that inventory has got liquidated this quarter. So we rather anticipate a flip happening to the trends that we were seeing in the last 3 quarters, wherein primary sales this quarter could be very strong and could significantly outpace secondary sales that have happened this quarter.
Why do you say that it will not be one of the best quarters for consumer durables, like an IFB or a Whirlpool? What's the sense that you got?
So as far as refrigerators, washing machines or TVs are concerned, our interactions with dealers are indicating that demand has been a bit soft on the secondary side. From Diwali itself, we are understanding that demand had taken a bit of a beating. And to that extent, we anticipate that this quarter may happen to be a fairly slow one.
Okay, and Aditya, before we end, what's the sense on the smaller, small ticket consumer durables, like a wire and cables or probably even fans? What's the sense that you're getting in? Because companies like Havells and Bajaj Electricals and all, they've been doing well. What's your sense on how they will report their numbers?
I think for them, we should be having a fairly stable quarter. These companies enjoy much more stronger pricing power vis-a-vis white good appliance companies, and even customers are not too fussy about pricing. To that extent, we expect that these companies would be able to pass on increased costs that have that had impacted their margins a bit in last 2 or 3 quarters. And at the same time, we are not anticipating any revenue deceleration either. So I think whatever trends we've been seeing in last couple of quarters may very well continue playing out, wherein premium fans business should continue growing at a pace much faster than economy fans, and to that extent Havells should continue benefiting from that trend. On the lighting side, we do think that growth on the LED side has been fairly strong, and at the same time pricing pressure that had erupted 2 quarters back has started normalizing. So we should see a bit of margin improvement on the lighting side as well. Overall, we continue to feel that in this space, Havells should be able to grow at a pace faster than most of the companies.
Okay, Aditya, we leave it at that. Thanks so much for speaking to Bloomberg Quint, and we'll certainly looking to get you back once the numbers are totally out now. Back to you guys.
Thanks a lot, Darshan, for that interesting conversation. I'm just going to switch focus back to markets. By the way, we are at day's low, 11,567. Nifty is down 27 points. Bank Nifty is also succumbed to selling pressure. Just want to highlight the top loser on Nifty right now is Maruti. It's at day's low, down over 3% in trade. Just want to tell our viewers, almost 4% actually now. The company comes out with its numbers day after tomorrow, and we were actually having a conversation with one of the guests where Jai Bharat Maruti's numbers did not look that great, and they said probably this quarter will not be that good for the entire auto pack. But we'll watch out for the numbers. 3.6% lower, 7055 for Maruti. Very quickly, we'll take a quick break. On the other side, we'll tell you which are the Fab 4 stocks of the day and also get you some recommendations from the dealing room and closing strategies from our technical experts. Stay tuned.